Hello traders, Gary Wagner here just before 11 o'clock in Honolulu, 5 o'clock in New York on Thursday, the last day of the month, 31st day of July 2014, and this is the daily report for gold and silver. I think we will remember this day. Equities markets totally slammed today, actually giving up its gains for 2014. What is interesting is no safe haven or flight to quality buying came in the gold market. Gold currently trading off about $13 on the day, $13.82, $13.83 and change. The low 78.80 and the high 12.98.30. And as I said, currently we are off about 13 on the day. Silver also losing about 1% on the day, percent lower in gold, a little over 1% lower in silver. Current print on the screen, 2037 off of a low of 2025, high of 2084. More on silver towards the end of the show. There's no doubt about it. We have an interesting day in the market. Equities just getting slammed. And what I really find to be interesting is fundamentally, we had decent economic data coming out. And it seems as though that economic data was totally ignored. And what was focused upon in the equities markets was the geopolitical turmoil or uncertainty and concerns about some global problems that we might have. However, we didn't see that reaction come into gold. In other words, we had the same concerns about geopolitical unrest and uncertainty, but it didn't seem to be supportive at all of the gold market. Perplexing when you consider that traders are looking to pick and choose how they want to interpret certain fundamental pieces of data and apply it completely differently to two separate markets. Neither here nor there. Let's take a look at the technicals because I think we're at an interesting point in the market. We talked about the fact that from June up to about the first part of July, we had a pretty significant rally, $100 rally. From there, my belief is we went into a corrective period composed of an A, B, and our C. What is interesting is the fact if you look at the low being 78, I believe, according to Kitco, but we've gotten right to that low. We're just off of it, 12.82 and change, down about $13. What's more important to me is the fact that we are at that 61% retracement, because that tells us if we can find some sort of a base right in here, this is a logical point we want to look to initiate long positions. Of course, we've got to get some sort of technical confirmation. We did have a pretty sizable correction from our last longer rally, which turned out to be about a 76% retracement. So 61 may or may not hold, but at least at present, this was the mark we were looking for, because as I said, if it cannot hold 1291, the 50% retracement of this most recent rally, we almost most certainly would come and test this particular low, and this would be the area that we want to see if we get a conclusion to this C wave. And on this C wave, the real question is, will we see whether it's a candlestick pattern, Japanese average, or other indicators pointing out a potential bottom in the market? Because if in fact we can see that, I think that we might have a significant rally that would follow, because realize as we look at this, and this of course is a subcount, this is all part and parcel of what I believe is an intermediate 3. We'll talk about that in a second when I pull up a weekly chart so we can put it into perspective. But that particular wave, in other words, this third wave, I believe is composed of R1, R2, we will get a 3, a 4, and then a fifth wave up if in fact we go back into an impulse cycle. So I think we're at a really crossroads critical area, and this is the area we've been waiting for to see if the market can find some support. It's a little early to tell that, but this is the area we want to look at. So as we talked about yesterday, and now it looks a lot more clear to me, we've gone ahead and pulled up a weekly chart. And on this weekly chart, there's no doubt we've got our record top just over 1900. We have the market in a defined bear sell-off in which we saw it give back last year, 2013, 30% in terms of value. We then got this bottom. And this, of course, right here, this is 2013 throughout, and this, of course, is the beginning of this year, 2014. So this was the first occurrence of 1180. Market comes up, over 14 comes back down, and then we get the second occurrence. And so what I am looking at as a possibility in terms of our intermediate count, and the intermediate count, of course, to me is what is really important. If we have our second bottom here, and again, this would be a shorter term view of the market, meaning the intermediate, not our major. This is what we would be looking at. And let me try to clarify that. I've got our daily chart up here, so you can see in terms of our subcount, a corrective and then an impulse. Since we have this double bottom, I'm really starting our count right here, beginning of 2014, and I believe intermediate, this was a wave 1. I believe that this correction here, this was our wave 2 correction. And that wave 2 correction came to a little bit over 61%, not quite 76% of this rally here. So it's still in alignment, although it was more than that. And I believe that what we're looking at currently right in here is the beginning of a wave 3. So you have 1, 2, and then as I said, here's 3. But when we look at 3, our subcount of 3 is 1. Let's see if 2 concludes here at 61%. Then we would get a third, a fourth, and a fifth. Now, this is not to scale. This is not where I'm looking for the market to go. But the key is for us to get the technical evidence needed to not only identify but this particular trend in this count, but to verify it, we would need to see highs that go above 1400. In other words, it has to break above this top. If this is wave 1, this is wave 2, it doesn't go below that of wave 1. Then we have 3 coming in, 1, 2, and this is what we're looking at. If in fact this is a valid model right now, we are just entering upon technical confirmation, of course, of the termination of this most recent correction. We are going into that 3 out of 3 subcount intermediate, and then of course there's a major above that. And then the last chart that I do want to look at on today's show is going to be our 2-day chart with our Andrews pitchfork, because in terms of getting technical confirmation, the fact that technicals for the most part are lagging indicators, we really won't get that confirmation until we get that V. In other words, we get confirmation as a market goes down once we see that pivot point. However, we've identified the fact that this market for the first time has genuinely broke and traded above this long-standing cascading channel lines that go down. And if you notice, what I've been saying over the last couple of weeks is we'll probably see the market come down too. But if this is a valid impulse phase that we're in, as opposed to this corrective phase that we've been in, it really cannot breach into here, and in fact could go very, very close to the bottom of this zero outer prong, and then would need to bounce off. So we'd be looking at something like this. Here's our impulse up, our corrective down, and then we would get another impulse up. And so, traders, that's what I'm looking at. The fact that we have sold off to this point is genuinely, on a technical basis, what we were looking for. It's our first sign. This is where we want to look for a bottom, and this is where we think we could potentially see an excellent trade coming aboard for those traders that are short. This is a point you might want to look to cover any short positions. And I bring that up because I've gotten emails from more than a few subscribers that are going short, and this would be the point that you would possibly look to cover. So as far as silver goes, silver has been acting differently than gold. There's been no doubt about it. We saw the same type of rally that really started beginning of June, moves the market up. However, when we look at the bottom that silver hit, it was certainly not a double bottom, and in fact was a lower low. So we're not really, in my opinion, in the same type of market in terms of a count, in terms of Elliott wave. We're right in mid-ground, below 38, but we haven't quite hit 50 50% retracement, of course, would be 2011. Silver moved up substantially higher than gold in terms of percentage gains and has not come down in terms of percentage losses, or it hasn't given up as much. So my sense with silver is, yes, it will trade in tandem, but it's an industrial metal. If we see pressure in the equities markets, we could see continued pressure in silver. This has been Gary Wagner wishing you, as always, good trading. We will talk to you tomorrow on Friday for the weekly wrap-up and review. Bye-bye.